Welcome to Biz Wire. I'm Joseph Nordstrom in Beijing. China's central bank has reassured financial markets that it will provide enough liquidity to support economic growth. The comments have eased investors' fears of a credit crunch, ending a week of panic selling, rattling investors around the globe. The People's Bank of China said at a news conference Tuesday that it had injected funds into some financial institutions in recent days to beef up their liquidity, and that surging interbank lending rates are the result of seasonal factors which will vanish soon. But J.P. Morgan released the best explanation of events so far when it said the tight liquidity is coming from a crackdown on illegal bond trading. In recent years, wealth management products, or WMPs, have become an important channel for Chinese banks to attract deposits as normal accounts pay interest below the rate of inflation. Most WMPs are short maturity with 65% below 3 months. In order to attract deposits, banks buy high-yielding bonds with 1 to 5 year maturities to serve as underlying of the WMP. Examples of such bonds are lowly rated credit papers with poor liquidity or non-standard securities such as discounted bills and bank loans. This has resulted in a term mismatch between the maturity of WMPs and their underlying assets. To avoid a squeeze from maturity mismatches, small banks started to engage in a kind of sale and buyback operation of the underlying bonds. In step one, bonds were sold before quarter end in what was described as a fake sale to a friendly counterparty, with the aim to obtain cash to pay back the maturing WMP. In a second phase of the trade, the bond was then bought back using cash from new WMP issues. Throwing a monkey wrench into all of this in May, the regulator banned this practice as part of a general clampdown of the abuses in the WMP market. Part of the interest rate squeeze we are observing today is due to the difficulty in selling the underlying bonds before the maturity date of the WMPs at the end of June. The demand for cash has therefore risen significantly, at least from these small banks who are primarily the ones that are suffering. Fears of a liquidity crisis in the Chinese banking system has resulted in panic selling in Asian stock markets, driving down share prices by more than 10% within the past 2 days. China's problems were compounded by concerns that the U.S. Federal Reserve might prematurely end its monetary stimulus after Fed Chairman Ben Bernanke said last week the bank's bond-buying program would end next year. On Tuesday, the comments from the PBOC offered some reassurance to global equity markets, lifting shares off post-financial crisis lows. Chinese stock markets already paired losses of up to 6% in early trading on Tuesday, closing just 0.3% lower. Shanghai's benchmark index was down nearly 1% intraday on Wednesday. Even the New York Times editorial board offered their advice on the situation, writing that the Chinese government should move to stop controlling the interest rate on savings accounts, which are lower than inflation. The board says that removing controls over those rates would reduce the demand for WMPs and reward ordinary savers. Another important reform the Times wrote, but one that would be much harder to implement, would be to reduce the influence that government and Communist Party officials have on loan decisions, freeing bankers to lend to deserving businesses rather than inefficient state-owned firms. It would be remarkable if Xi Jinping and Li Keqiang could enact such market-based reforms as they said they would like to, as there are so many layers of entrenched interests that benefit from the status quo, or those who are loath to move away from a state-controlled model. You're watching Biz Wire on the Blue Ocean Network. Stay tuned for more in Economic Insight.